All right, so what we'll do now is look at the effects on, okay, there we go, I'm like that. Now, when we look at the accounting equation, we're going to expand it a little bit, because now that we have revenue and expenses, we want to make sure you know where they go. So the accounting equation is our balance sheet, right? So if we write assets equal liabilities plus stockholders' equity, and I'm going to keep it on the right side of the board here. We said that assets carry what balance? Debit. Liabilities carry credit. And stockholders' equity carries credit. Our two main items under stockholders' equity are common stock and retained earnings. And they both carry what balance? Credits. But remember when we were going through these, I said that was like 95% of the time, right? If you remember the accounting, the statement of retained earnings is beginning retained earnings plus net income minus dividends equals ending retained earnings. So what we're going to do is we're going to add three things under retained earnings: revenue, expenses, and dividends. Revenue and expenses are net income. So beginning retained earnings plus net income, which is revenue and expenses, minus dividends. So revenue is a positive thing, correct? We want to make revenue. So we want revenue to increase retained earnings. So what balance will revenue carry? If retained earnings carries credit and we want revenue to increase retained earnings, it also needs to carry a credit balance. Expenses are going to decrease retained earnings because they decrease revenue, right? So what balance are expenses going to carry? Debit. And dividends are also going to decrease retained earnings, so they're going to carry a debit balance. So expenses and dividends are the two things under retained earnings that are going to decrease retained earnings. Now, on this example here, they don't show dividends, but I think that's dumb because it's part of it. We just aren't doing them quite yet, so that's why I go ahead and talk about dividends going under there right now. So your revenues and your expenses go under retained earnings, and they just slide under there. So when we're doing the accounting equation, you just slide those right underneath that. So when we're talking about these journal entries next, you're going to see that. Okay, so for example, if we sold $3,000 worth of games online, remember this is a, what's it called, Noodle Cake sells games, like electronic games, apps. So if we sold $3,000 worth of games, first of all, what did we get? How did we sell these games? We sold them for cash, so we got cash. Did we earn money in September? Yes, because we're in the business of selling apps or software. So if we sold those games, then we made money. So this is where you're going to see the revenue and expenses over here on the right to stockholders' equity. So cash and sales revenue. And it's sales revenue because we could have had some type of cost. We're not selling a service, we're selling a game. So the journal entry is going to be a debit to cash and a credit to sales revenue. Now, you're going to have very little to do with the analyze. I'm going to show it to you here so you can see how it affects revenue and expenses. But from your standpoint, you're going to be just doing that journal entry. And then, of course, it's going to summarize it there in the T accounts. All right, the next one. We issued 3 gift cards at the beginning of September for $100 each. So gift cards are something different, right? So first of all, we issued 3 gift cards for cash. What did we get? Cash. How much? $300. Where are we going to put this? Is it revenue? Did we earn the money? It is unearned revenue. We're going to earn it when they spend it, right? Because will they necessarily spend it all? No. And we don't know if they're going to spend it this month, next month, or next year. All right, so it's cash and deferred or unearned revenue. So that does not affect anything with revenue. It's a liability. Now, there aren't many companies that take gift cards back, but there's a company that buys gift cards, but there's not a lot of companies that take gift cards back. All right, now we sold $9,000 of apps in the App Store. And we sold these on credit. So what's going to be different with this one? Exactly. Accounts receivable now instead, but it is still revenue. All right, doesn't matter how we sold it, it's accounts receivable and sales revenue. So notice it's plus R and plus SC, basically just saying that your stockholders' equity is going up. Noodle Cake received a check totaling $8,500 from Google. This is nothing new to this chapter. We received a check, so we're going to debit cash and credit accounts receivable. So when you're going through these journal entries, don't get stuck on the ones that aren't new. We paid employees $7,800 for work in September. And we paid them cash. What are we going to debit? We had it on the board earlier. Wages expense. Well, except for it's not wages payable because we paid them with cash. Okay, but wages expense and cash. Sometimes it is cash. Sometimes it's wages payable. The way the college pays, since they pay us once a month, they never have wages payable because they always pay us at the end of the month. So they never have a day going into the next month because they pay us at the end of the month. For companies that pay bi-weekly or every other week, you are going to, at points, have days that the end of the month fell on a Monday, Tuesday, Wednesday, Thursday, so you're going to have payables. When companies pay only on once a month, they don't have that. It sucks to get paid once a month, but for companies it works. All right, now what about we paid in advance $7,200 for rent? We paid for September, October, November, and right now it's September 1st. What did we say we were going to do here? Prepaid rent, and they paid cash, so cash. Prepaid rent and cash. So both are assets. Now, Noodle Cake displayed an online ad in September, and then we received the bill to be paid in October. We displayed the ad in September and got the bill to be paid in October.
Ad expense.
Ad expense and
Card. Or I guess, accounts receivable. Yeah. No.
accounts payable. Yep, cash and accounts payable. I mean cash and accounts payable. Ad expense and accounts payable. Because we did not pay them. And then we paid cash for expenses. So Noodle Cake was notified by the bank that an automatic payment of $600 was transmitted for electricity. So it's going to be utility expense, electricity expense, and cash. Now for me, I'm very, whatever, utility, electricity, but in Connect, you want to make sure that you pull down the right one. So make sure they're not being too specific. And then when you're done, this is what it looks like. You got all these T accounts now that exist, or your general ledger, that exist with all these different expenses, revenue, and of course, deferred or unearned revenue. So you got a lot more T accounts that are going to lead to your unadjusted trial balance. So let's go back to the problems. Okay, we'll go ahead. With this one, the reason I like this example versus one that was actually in your book, I like that it had different companies for each one, so you don't kind of get standard with the journal entries. So let's go ahead and take a look. So the first one is a customer paid $20 for 15 songs from the Sync eTunes store. So first of all, does this affect revenue in October? Yes. All right. So how much revenue is going to be recognized? How much? $20 or $20 for cash for 15 songs. So was it $20 or $20 times 15? I think it's $20 times 15. How many of you guys just put 20? I took it as 20 times 15. Let's see what the book says. Nope, they said 20. I thought it was 20 times 15, so I would have got it wrong. I interpreted that. That's all. I guess if you look at it, I'm used to always having to multiply. I looked at it as they paid $20 per song, but that would be stupid, so I don't know why I looked at it like that. So, all right, so what's the journal entry then? I wanted you to go ahead and do that. What's the journal entry? Cash and revenue. So a debit to cash for 20, not whatever would have been the multiplication, and a credit to revenue. All right, Comfort Depot provided carpet installation for $2,600 cash. A carpet installation from another company would have been $3,100. So is that revenue in October? Assuming it was installed. Yeah. Yes, it is. Okay. And how much is the revenue going to be? $2,600. What's the $3,100 mean? Really nothing. It just really means they got a good deal, right? You record it at your cost. You always record at your cost. So the journal entry is going to be a debit to installation expense. Okay, so this one's different, right? We didn't get cash, so it's not a debit to cash. We provided, carpet installation provided installation, a comparable company would have. So they did installation. The company did installation for $2,600 cash. So what did they get? They got cash. Okay. And then they had revenue. So it is revenue. So it would be debit to cash and credit to revenue. All right. Ignite company is scheduled to install cable. So the company is going to install cable at 600 homes in Georgetown next week. The installation charge is $120 per home, and the terms require the payment within 45 days. Is the revenue going to be recognized in October? No. Why not?
It's just stating this is what we're going to do.
Right. They haven't done anything. They're scheduled to do that. So could they be pushed back? Oh, yes. If you've never sat at home waiting for something to show up, it gets rescheduled all the time. So nothing, it's only a promise, nothing was scheduled or exchanged. Now, they actually scheduled it. So, remember the terms. The terms said that it was $145 for 600 homes that had to be paid 45 days. Yeah.
Wait, so you don't put anything on C?
On C, there was nothing. It was only a promise. Now that we're in D, now they did the work. Accounts receivable and revenue. So yes, an obligation has been fulfilled. This is the multiplication. See, I knew one of them was multiplied. You got to take 600 homes times 145. So debit to accounts receivable, credit to revenue. And then I think this is the last one. Ignite received the payment from the customers for the digital cable. Is that revenue in October? No, because you just told me it was revenue already, right? So now what are we going to do? What's the journal entry? Cash, debit, and accounts receivable, credit. We already recognized the revenue. Those are the ones that you guys sometimes get stuck on because you want to recognize it again, but you just did it.
Do we still make a journal? So we make a journal entry for that?
You make a journal entry for debit to cash and credit to accounts receivable, but no revenue would be recognized. C's no. Yep. A customer purchased a ticket from Cooper Airlines in October for $600 to travel in December. Is that revenue in October? Unearned revenue in October. So it will not be revenue. So no, it will not be. So we're going to debit what account? Cash and credit unearned revenue. Okay, now go ahead and flip it over one more page, and you are going to see 6 journal entries for expenses.
You said the journal entry was
For E, you're going to, oh, I got to flip backwards. E, you're going to debit cash and credit accounts receivable.
the same amount.
Same amount because they said they paid it, yeah. So I think it was 72,000. Yeah. So now flip it, and you're going to look at these 6 expenses. Go through the same thing. Is it an expense in January this time? Not October. January, and then do the journal entry. let's take a look. So, okay, so this time around, let's take it. First one, 11 paid service technicians, 88,500 in salary for work that was done in January. So is that going to be an expense in January? Yes, that is one of our very typical ones. What are we going to debit? Salary expense or wages expense, and credit cash. All right, at the beginning of January, the Potter Company paid $3,500 in rent for February, March, and April. Is that going to be an expense in January? No. I know and a yes and a smile. All right, it's not an expense in January. We paid for it. So how are we going to record it? Prepaid rent and a credit to cash. It's going to be an expense in February, in March, and in April. It will be rent expense in each of those months. And we'll do that with adjusting entries, which we'll learn about next week. That's chapter 4. So right now it's prepaid rent and cash. All right, Wiley Publishers used $36.50 worth of electricity and natural gas in January, which has not yet been paid or recorded. So sometimes when it says or recorded, that just means you haven't done the journal entry. All right. So is that an expense in January? Yes, because it says it was in January. So $36.50. What's the journal entry? Utilities expense and accounts payable. You could have also said electricity expense. That would have been fine in accounts payable. William Smith Company received and paid in January 1850 invoice for a consulting firm for services they received. So they received the services. They didn't provide the services. That would be revenue. They received the services in January. So is that going to be an expense in January? Yes. So it's going to be services received in January, yes, 1850. What's going to be the journal entry? Yep, consulting expense and cash, because they paid it in January. All right, the campus bookstore received consulting services at the end, at a cost of $48.90. The terms indicated that they're going to have to pay in the next 30 days. Is that an expense in January? Yes. What's going to be the journal entry? Consulting expense and accounts payable. Yes. And then Cooper's indicated or incorporated had its delivery van repaired in January for $320 and charged that amount. So is that an expense in January? Yep. And they're going to charge it, so it's going to be van repair expense, some type of an expense, right? And credit, accounts payable, yes. I knew where you were going with that. All right. So the remaining slides talk about an unadjusted trial balance. All right, so the last part of this is dealing with the unadjusted trial balance. Now, we talked a little bit about that in Chapter 2. They just talked about the trial balance, but I told you it was actually the unadjusted trial balance. The thing that you want to notice about the unadjusted trial balance is look at here on the right. It actually says balance sheet accounts, income statement accounts. It is done in the order that you can then do your financial statements based off the trial balance. All right. It's not done on debits first and then credits. It's done in the order of the financial statements, which comes from the general ledger, or in our case, the T accounts that we're doing it from. So you list all your balance sheet assets, then your liabilities, then your equity, then your income statement accounts. And if you notice, right between the balance sheet and income statement, the the common stock 10,000 and retained earnings 0, you pull right through that retained earnings, that's going to be your statement of retained earnings. It's just right now you only have one thing because retained earnings is 0. You're going to calculate your net income, and there is no dividends in this case. So that is your balance sheet, your statement of retained earnings, and your income statement. Now this is a small one. It's the unadjusted. The adjusted gets much bigger because in Chapter 4 we have a lot more expense accounts that are added. And remember, the only reason we do a trial balance is what? So things balance. Our debits equal our credits. And it just shows you where we're pulling these numbers from, remember. And then the next couple things, just review what we talked about at the beginning. Now we did this in one day, so it doesn't really take the same review. but it's out here if you need to take a look at it. And then we have one ratio. Now in chapter 2, it was the current ratio, which I told you was an important one, but you kind of had to look at it and say, what does that mean? What do you think the profit margin evaluates? It kind of gives it away, doesn't it? What's profit margin going to be looking at? Your profit on your company, all right? So in order to look at the profit of the company, you're going to look at net income and you're going to look at revenue. That's how you evaluate your profit. Net income divided by revenue, because net income takes into account expenses and then overall revenue. How well are you managing your expenses? The better you manage your expenses, the higher your profit margin, right? Which is overall what we want, right? We want a high profit margin. We're not looking at gross profit right now. That's a whole different ballgame. We're looking at profit margin. So we get their net income to be $3,100. Their revenue is $12,000. This is a software development company, and their net profit margin is almost 26%. What do you think? How can we tell if this is good?
Compared to other companies.
Perfect answer. Compared to other companies. There's no other way you can really tell, except for the fact that if it was 1%, you knew that would be bad. All right? There's ways to tell if it's bad. How can you tell if it's really good? You have to compare it. Because if all the other companies you can think of, Electronic Arts, what's my other one? My other big one. Electronic Arts is sports, and Call of Duty is like Ubisoft or something like that. So you get those. You can't compare numbers because look at this. Total debits is 53,000 with cash being 16,900. You can't compare that to Electronic Arts. They're in the millions. So you can't compare their assets and you can't compare their revenues. So the only way you can compare them is by ratios. That's what's so great about ratios. You can compare any size company by looking at the ratios. So how does this startup company compare to Electronic Arts ratio-wise? And if you see that their their net profit is almost 26%, and you look at Electronic Arts and theirs is in their mid-20s, then they're doing pretty good. If you look at Electronic Arts and their net profit margin is 35%, then you're going to be like, okay, where are our expenses higher than theirs? Or you look at it the other way around and Electronic Arts is 20, then you feel really good about yourself, right? And you're on a good start. So that's why you need to look at it. You got to compare yourself to others in your industry. You cannot compare these guys to Target. And why would you, right? You need to compare like industries. I would think this was probably pretty good. You look at a Home Depot, you're probably looking at like a 4 to 6% profit margin. Why? Because you're buying the stuff you have a smaller profit margin when you buy things and turn around and sell them. Now, a couple things about the income statement when it comes to limitations. Number one, it is not cash. When you look at the income statement, you don't know how well a company's actually doing because can my net income be fantastically high and I have no money? Yeah, we talked about that with the example of Ed Sheeran. And if we looked in December, he could have millions of dollars, right? And that could all be on accounts receivable, technically. And what if Ed Sheeran never collected it? That happens with some companies. And I told you about that video. I really hope we have time to show you at the end of the semester. One of the reasons that kid looked so good is because he never collected any accounts receivable. His income statement was great, but all of his sales were on account. He never had any cash sales. So his income statement looked fantastic. And his balance sheet looked great because his accounts receivable was great. That's an asset. He never collected. So that is a problem. So net income also doesn't equal value because you're collecting and you're posting your revenue when you earn it, not when it happens. So you don't really know when you made those sales. And net income is not exact. So that also comes into play.